Welcome back to Protecting and Preserving Wealth. I'm John Jagay, joined as always by Bruce Hosler and Jason Hosler of Hosler Wealth Management. Good to be with both of you guys today.
Great to be with you, John. Thanks for joining us.
Good morning, John. Good to be here.
All right, I love talking to the two of you because you always kind of have your fingers on the pulse of what's going on in this world. And Bruce, I know you just got back from your spring Slott Master Elite IRA Advisors Conference. You've got some updates for us, some retirement and IRS stuff that you want to share with our listeners. Where do we start?
Well, first of all, I want to just give a little history. I just came back from Slott. They celebrated the 20 years that he's had this Slott Elite Advisor group, and I realized that I'm coming up on about 19 of those years. I was just a year or so into it. So I've had quite a few years of going to this. I go twice a year. We spend 3 days going on all the updates on the tax law changes. There's 3 updates that I want to pass along to our listeners to help them navigate the new tax rules, some that I think that people aren't aware of. So, Jason, let's start with the new Form 1099-R for QCDs. Folks, QCDs are Qualified Charitable Distributions. What are we talking about on a QCD, Jason? What is that?
I'm excited about this one because this is one of those overlooked areas that the IRS seems to have neglected for a while in their reporting regime. Another great example of this was last decade, they passed a law where the various companies had to finally start reporting the basis on stocks and bonds and mutual funds. And you realize that they weren't reporting that to the IRS and everyone was just making it up on their own. Oh my goodness, they have these gaps sometimes that are just kind of crazy. The QCD is one of those. A qualified charitable distribution is a distribution that you make from your traditional IRA directly to a charity. So when you are charitably inclined, you can make that distribution, and it does not count as taxable income on your own tax return. But what it does do is it will fulfill a required minimum distribution if you need to make one of those. So it's a very strong planning tool in a number of scenarios for being able to meet your required minimum distribution and not have to include it in your taxable income.
There is a requirement, folks. You must be 70 and a half years old in order to perform a QCD. And when they say 70 and a half, that means you can't actually affect it until you're 70 and a half. So if you turn 70 in January of 2025, you have to wait till the second half of the year until you're 70 and a half to do your QCD. Now, you don't have an RMD when you're 70 and a half, but if you're charitably inclined, you may want to go ahead and give some of that money away so you don't have to have taxable IRA income later. You can give that money out of your IRA. Very attractive. Up until now, you had to be sure that your tax accountant knew when you did a QCD because there was no paperwork from your IRA custodian to tell your tax professional, hey, by the way, that $50,000 that I gave to the college is not that IRA distribution, that 1099, that was a QCD. If they don't know, they just put it in there and you paid the $50,000 and the charity got it. They didn't recognize taxes, but you did. You shouldn't have had to do that.
Just to be clear, Bruce, you say $50,000 to the college. You're talking about a QCD, not what tuition is ballooned to these days.
Right. No, I'm just talking about the gift. I'm just talking about the charitable gift from your IRA that you don't have to count. Well, we have a couple of codes on the new 1099-R, and it will be a code 7 for a no more IRA distribution. It'll be a code 4 on an inherited IRA. Hey, look, your mom and dad died. They left you an IRA. If you're 70 and a half, you can do a QCD. And that code will be 4 on the 1099-R that comes out. So you can do those. And finally, it'll be a code K if you take it out of other asset IRAs, like an IRA that is real estate or gold, something that's not a security and readily valued. Now, how does this change take effect? Well, on this next year, when you start doing your QCDs, it's going to come on your 1099-R. So this is really a great thing. So what do we want to remind our listeners about this, Jason?
You want to be making QCDs generally early in the year to make sure that you are covering your required minimum distribution. The first dollars out of your IRA, if you do have a required minimum distribution, have to go towards that. So if you do your QCD early to make sure that you're meeting that requirement, that just keeps everything cleaner in a tax year.
Assuming you are 70 and a half, of course.
Assuming
Yes.
you're 70 and a half. Now, even if you have this new 1099-R, folks, you need to still tell your tax professional that you're doing a QCD and the amount and the date so it can get correctly reported on your return. The software allowed us to put on the left-hand side QCD, and that way the IRS knew that that wasn't taxable, even though the distribution's in the middle of the 1040 on those forms. So just be aware of that.
Yep.
The second thing I want to talk about now is Form 8606. Now, this form is designed for anybody who is making an IRA contribution and they're taking a distribution in the same year. How much of that distribution is taxable? That is determined on the 8606. So it's kind of a calculation form, and it's used to track what's called cost basis in an IRA. Now, you may say, Bruce, what do you mean cost basis? IRAs don't have a cost basis because they're qualified money and all the money in an IRA is taxable. Well, that's not exactly true if you have non-taxable money inside of your IRA. Now, Jason, how do we get non-taxable money inside of our IRA? What do we have to do to get what's called basis in an IRA?
The main way is going to be making a non-deductible IRA contribution. You'll see a lot of people talk about this online with the backdoor Roth concept. So if you have no other IRAs and you make a non-deductible contribution, you're not limited on making a non-deductible contribution. People will then turn right around and they'll convert that to a Roth IRA. So if you don't convert it, though, if you make a non-deductible contribution and you already have IRAs, they have to calculate how much of that is basis versus how much is tax deferred. And so the 8606 tracks all of that.
So, folks, here is a very important recommendation for you. If you have any basis in your IRA, you want to make sure that your tax preparer checks the box in the software and files an 8606 every year. Even though you're not making a contribution or a Roth conversion this year, or you're taking a distribution this year, I still want you to file 8606. Why do I want you to do that? Well, this is what I want you to think about. How long does the IRS keep tax returns, Jason? How many years do we have to amend a tax return?
So you have 3 years to go back to amend a return, and the IRS can look back 7.
If there's fraud or they think
Right.
there's other untoward actions on a return. So if that's the case, 3 years from now, if you file the 8606 this year, the IRS has got rid of all those tax returns. They're not looking at it. It's not a current number in front of them. So I want our clients to always have that cost basis on the return in the last 3 years. So if we take a distribution out and we're saying, hey, we're taking 100,000 out and 50% of our IRA has basis in it, so only 50,000 of the 100,000 is taxable, and we put that on the return. Do you think there might be a few flags and a few bells going ding, 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 ding at the IRS going, this is taxable. We've got a hot one on, man. They're going to reel you in. You have to have that 8606 in the IRS records so they don't try and take your free money that you've paid basis on already.
For the record, for those of you listening to the audio version of the podcast, the sound that Bruce made when he reeled it in was topped only by the motion of him catching a fish as he was doing it.
That fish is running, baby. Okay, let's talk about our last topic here, which is violating the one rollover per year rule. One rollover per year. Now, let's define what the one per year is, Jason. What is one rollover per year? What are the terms of that?
Well, a lot of people are going to think automatically that it's a tax year, but it doesn't work that way. It's the last 12 calendar months. So if you made a rollover here in May of 2025, that starts the clock for 12 months from now to May of 2026 before you can do another rollover without dinging yourself on this rule.
Now, I want to clarify two things that Jason said there, folks, because I want to translate it to pure human American English. He said the tax year, and I want you all to know that as an American individual filing, your tax year is a calendar year. January 1st, December 31st. That is your tax year. So that's the calendar year, and that is your tax year. And when he says only once per year around there, it is technically 365 days. They count the days. So today we're on May 22nd. It is through May 23rd next year before you can do another rollover. They actually count the days.
And don't forget leap year too.
And leap year too. And it begins on the day that you receive the distribution. So if you request a distribution from Fidelity and they mail it out, it's the day that you receive it in the mail. That starts the clock. Well, what if we don't mail it, folks? What if we just do a transfer from your IRA and it goes into your checking account? Boom.
Right there, the clock is starting. Yep.
So it's the day that the taxpayer receives the money. Now, what if you take another distribution, Jason, in that 1 year? What happens?
Well, you could blow up that rollover and potentially the entire account could become taxable.
Oof.
The entire account does become taxable because you took a distribution. This is a very expensive mistake, folks. Very expensive. So let's also talk for a second. If you take another distribution, it can be a different IRA account, and I don't want anybody to make this mistake. When I was at Slott, one of the examples that they gave us was there was a brand new young advisor, and he was speaking to a lady, and she had an old advisor, and she didn't like him very much. And the old advisor said, look, if you're serious, you need to move over $10,000 of your $3 million IRA to me. So she moved over $10,000 to him. She went to the bank, got a check, gave it to that old advisor. He was not very polite to her. She didn't like him. The new advisor was very friendly, and he was on top of it. He says, let me help you. Go to the bank, get your $3 million, the rest of your $3 million, bring it over, and I'll put it into an account. That new young advisor just caused her to break the rule, and the whole $3 million is taxable for that year.
Wow.
Now, folks, here's the other thing you do. I know, you trust us and love us, but you might have your own little IRA account that I'm going to call it your gambling account. It's your account where you want to trade your stocks yourself. Schwab, Fidelity, E-Trade, wherever it's at. If you take a distribution out of there and you don't tell us and we have to take another distribution, you just broke the rule.
Wow, that's
So,
huge.
Different IRAs at different custodians can blow this up. I'm just trying to put you all on notice. You don't want to take distributions where you take possession of the money. That means the check is deposited in your checking account. What do we want instead, Jason?
We want to do a trustee-to-trustee transfer. And when we start working with a new client, almost 100% of the time, that's the way that it goes now. All of these institutions are able to talk to each other on the back end. So you would open a new IRA, you'd have the old trustee send the funds directly to the new account. They never come into your possession. You never touch them. And when it's a direct transfer like that, then you're avoiding some of the pitfalls associated with this rule.
Absolutely. The other one that we sometimes run into is what I'm going to call a direct transfer. And that happens frequently if you have a IRA, a 401k, if you have a 401k account and you want to roll over your retirement account to an IRA, the 401k plan will demand, can you believe this? They'll send $500,000, $1 million 401k. They'll mail it through regular mail to your house. But they'll make the check payable to the new custodian. That's what you want to have happen. That avoids a rollover. That's just a direct transfer.
All right, so Bruce, my key takeaway here is it needs to be custodian to custodian. The check or the distribution cannot be made out to you as an individual person.
The check is made out or the transfer goes to the new IRA custodian.
not to you as
Not to you. You don't take possession. You don't have the check made payable to you.
Got it.
And where that comes in, if people have IRAs at banks, they tend to write checks back to the people. That's where you get in trouble. Your regular financial advisors are a little bit more aware of this, but that doesn't mean that somebody can't call up their advisor and say, "Hey, I want my IRA. Send it to me, and I'm gonna go put it in my bank." That's a rollover because you got the check and now you're going to deposit it and it was made payable to you.
Let's go through which types of transfers this rule applies to and which it does not apply to.
The transfers that are subject to this rule is if you go IRA to IRA or Roth IRA to Roth IRA. And you see me holding up my hands for zero because Roth is non-taxable, but you still blew up the Roth and you lost all the tax advantages of it if you distribute that. And it's treated as a distribution if you do that in a year. You may not pay the tax, but you just lost all the rest of that tax-free growth. You paid all the taxes to get into the Roth, and now you just blew up your Roth.
Catastrophic. You can't do that.
Yeah, it is catastrophic. Now, the following transfers are not subject to this rule. So if you go from a 401k to an IRA, that's not subject to this because they'll do a direct transfer almost always. An IRA back to a plan, if you want to, you're working, you have an IRA, you want to put it in your 401k plan, that's not subject to the once per year. And then if you do an IRA to Roth conversion, that is not subject to once per year. So we will do multiple Roth conversions within a year. Now, we always do them trustee to trustee, but that's not subject to the once per year rule. Now, the rules are easy to blow up and make a catastrophic mistake. That's what I'm trying to get in front of you with on this. So if you always use a trustee-to-trustee transfer, that's pretty much the best way to protect yourself when you do that. Those are the kind of the main three that I wanted to cover from Ed Slott here, and I think this will help protect you on some of these new tax law updates in 2025.
So, Bruce, I was going to ask you that. These apply to the 2025 tax year that you'll file.
Well, they've already been in place, the once per year rule, and so is the 8606. But the new one this year is that 1099R for QCDs. That's brand new. That just came out. But I wanted to refresh these other two because I think the rules that apply to people, that we see people make catastrophic mistakes, not filing the 8606, you know, you get 5 or 10 years in and you have a lot of basis in an IRA, and the IRS says, no, you don't have any basis in there, and you don't have that current in your records if you're not tracking that. And, you know, a lot of people are like, they want to clean things out. Hey, 7 years, they got rid of it. Well, they got rid of everything that was 7 years older, and they didn't file an 8606 for the last 7 years, but they have basis in their IRA that they've had for 30 years. You just lost all that tax-free money in your IRA.
So as I said at the beginning of the podcast, I like talking to the two of you every couple of weeks because we really go through the current stuff and what people need to know today. But I think the other point you made today is avoiding those catastrophic mistakes. I mean, you start seeing dollar signs like that. That is really scary stuff. So if somebody wants to come talk to you and the team at Hosler Wealth Management, and they've got 2 offices, what are the best ways to find you?
Obviously, online, you can get us at hostlerwm.com. If they want to call Prescott, Jason?
Give us a call at 928-778-7666.
And in Scottsdale, folks, 480-994-7342.
Really important information, as always. Appreciate you both. We'll talk to you again in a couple weeks.
Thanks, John.
Thanks, John.
Investment advisory services are offered through Mutual Advisors, LLC, DBA Hosler Wealth Management, an SEC-registered investment advisor. Securities are offered through Mutual Securities, Inc., member FINRA SIPC. Mutual Advisors, LLC, and Mutual Securities, Inc., collectively Mutual Group, are affiliated companies. Forward-looking commentary should not be misconstrued as investment or financial advice. The advisor associated with this podcast is not monitored for comments, and any comments should be given directly to the office at the contact information specified. Any tax advice contained in this communication, including any attachments, is not intended or written to be used and cannot be used for the purpose of avoiding federal or state tax penalties. 2, promoting, marketing, or recommending to another party any transaction or matter addressed herein. And 3, tax preparation and accounting services are offered independently through Hosler Wealth Management Tax Services. Any tax advice provided by tax professionals under Hosler Wealth Management Tax Services is separate and unrelated to any advisory or security services offered through Mutual Group. The accuracy, completeness, and timeliness of the information contained in this podcast cannot be guaranteed. Mutual Group does not provide tax or legal advice. You should consult a legal or tax professional regarding your individual situation. Accordingly, Hosler Wealth Management does not warranty, guarantee, or make any representations or assume any liability with regard to financial results based on the use of the information in this podcast.